A very good morning to you in the big picture and to those joining us online. I'm Alison from the CICT Investor Relations team. A very welcome. CICT released its full year 2022 results this morning, and we have the management team here with us to share the highlights of CICT's results. I'll introduce them later. For today's briefing, we'll start off with a presentation by our CEO, Mr. Tony Tan, followed by a question and answer session. Please note that this session is live, recorded, and will be uploaded later on our website. Now, I'd like to invite Tony to start his presentation. Thank you, Tony.
Good morning. Just commented that it's a big place for a small crowd. So we released the result this morning. I hope you have a little bit of time to digest. I'll just quickly run through some of the key highlights, and then, of course, our management teams are here to take some questions. Okay, move this. Is it moving? Yeah, okay. So just a few key highlights which can be elaborated in the following slides. A few things I think will work out quite well in 2022. We have seen some nice improvement in the operating metrics. Committed occupancy, for example, has been going up over the year, over the quarter as well. And we have achieved rental reversion positive both for the retail and office, as well as a tenancy that's now already surpassed 2019. That includes downtown and suburban. So I think we're quite pleased with the overall general trends where we've seen in 2022, which is quite in line with what we talk about when we met in different occasions. On a sequential basis, we think running towards the end of the year, we should see nice uplift given there were a few momentum that has already triggered as a result of more relaxation from the COVID measures. Shopper traffic has been rising as well over the years, and of course, but towards the end of the year, we've seen in a way, leading to the festive period, we've seen quite nice uplift as well. Throughout the year, I've been very, very careful about how we look at costs, very active managing the costs. Everyone knows that inflation is hitting us in all front. Interest rates have been going up, utility bills has been going up as well. So we have been very proactively trying to manage all these different things, dynamics that's been hitting our expense line. I think we have achieved a reasonable output, given I've given a little bit of guidance on how the utility rate vis-a-vis 2021 has moved up, almost 90%, and rough estimate on how that will impact on the DPU front, but I think we came out better than that. We also secured quite a fair bit of financing from the market, in total 2.7 billion that we've secured in 2022. And we have hedged our energy rate throughout the course of the year. And 2023 is protected, albeit it's a higher rate. 2024 is protected as well. Given that we know that the volatility on the energy price is going to be still notwithstanding all the geopolitical and war issue that we've seen around the world, I think energy price will continue to stay elevated for quite a while. Capital management is going to be active this year. Hopefully, we are able to manage our balance sheet more effectively as well. We have done some proactive and very conservative management of balance sheet. You've seen the gearing came down a little bit, about 14.4% at the end of the year. I'm looking forward. We've been quite, of course, pleased to hear that China is opening up. At the end of the year, they talk about coming February, they're going to release more or less the floodgate to the rest of the world. That certainly would be helpful for the retail business, and especially in the downtown business. So we hope to see that trajectory coming in through in 2023. Also improving on the hospitality side. We have a couple of hospitality-related assets in our portfolio. The hotel in Raffles City, Live Funan in basically Funan. We've seen very healthy kind of RevPAR or occupancy. Yeah, so that's trending up pretty well. So from the number perspective, full year will achieve almost let's say 1.73% improvement on DPU. That's the I know it's below market consensus, but I think we have done a little bit of things. Hopefully, going forward, we've seen some improvement from there. Bear in mind that we also have certain, hopefully, potential measure that will help improve the operating number as well going to 2023. On the revenue side, so in distribution income side is up by 4.1% to 702 million. I'll talk a little bit more later on. So overall, portfolio occupancy has crept up to 95.8%. From third quarter, we reported 95.1%, so it's going up as well. Wales has came slightly from 3.8 years to 3.7. From a retail perspective, earlier I mentioned, I think the number trending well, quite well. Third quarter, we closed the third quarter, as in the year to date, September, retail sale was 21.3%. Today, we are looking at full year 22.5%. It's improvement as well. Suburban mall, again, downtown mall lead the suburban mall in terms of recovery, but surely because downtown mall has been getting a bigger hit throughout the COVID period, and hence you've seen the rebound very robust, and all of the various measures like the relaxation of the mask mandate. I think it's a critical turning point. A lot of people are starting to flow back to the office, and we've seen very healthy returning rate to the office. So downtown mall is seeing a little bit of uplift, a little bit of tourists trickling in as well. So we've seen a little bit of uplift from the tourist crowd as well. And suburban, as usual, remain pretty resilient. People are still working from either 3 days, 2 days from home, or 4-1, depends on which company you look at. But overall, I think suburban has been pretty resilient. Portfolio overall traffic has gone up, like I mentioned earlier, and it's led by downtown. Overall rental reversion, I did touch on earlier. I think it's all positive now, both the office and retail. And it's in fact, I think whether you measure it from a average perspective or incoming outgoing perspective, I think the retail reversion has gone positive as well. Valuation overall, if you look at overall for the whole 12 months, it's gone up by close to 9%. With a little bit of portfolio adjustment we did in the year, we divested One George Street towards the end of 2021. And then we had divestment of JQ. We acquired Capital Sky. We acquired and completed the 3 Australian assets. So there's a bit of movement. But overall, I think the valuation has gone up by about 9%. In terms of geographical split, slight movement only. I think Singapore portfolio share has gone up about just 1%, 93%, with 3% in Germany and 4% in Australia. This one I don't touch about too much. I think it's self-explanatory. Okay. So second half full year, I think revenue has gone up quite nicely, 14.4%, and MPI 13.1%. Margin-wise, I think we held steady. You know, we have trying to guide the market a little bit, try to move it, given all the different inflation number that has been coming in. We were hoping that we were able to achieve more than 70% margin. I think we achieved a reasonable margins, or close to 72% overall. Yeah. That's for the full year. Okay. I think for the first time we crossed our MPI by 1 billion. That's a big milestone. Of course, 1 billion is just a digit, but certainly it's a major milestone for CICT. Yeah. We continue to be probably one of the most diversified REITs in terms of different revenue streams, as you can see layout here. Singapore by far still the largest, and of course we have some minor contribution from Australia and Germany as well. Yeah. So we continue to build on that. Hopefully we get even a wider diversification. Singapore will still be very dominant. And I mentioned before, we hope that over time we are able to scale up in some of the 2 markets that we're already in. Balance sheets are healthy. NAV closed about 212, including the dividend, 2.06, excluding a dividend. Funding wise, I think we can rest assured that it's all covered. 1.166 billion, more than covered. We had that all the funding in place. It's about timing, drawing down, closing the documentation, and of course, at the right moment, we'll do the interest rate hedge. Right? And we've also done a little bit of sensitivity on the interest rate movement. And earlier, I was just discussing with some of you out there. Overall, I think we are quite happy because I think we had a pretty high hedge rate, and as a result, I think you see lesser volatility in terms of the impact from interest rate increase. Yeah. On the balance sheet wise, we close year with some improvement in the metrics. Gearing has came down to 40.4, a bit more proactive, make sure we don't have idle cash sitting around. Total borrowing came down a little bit, which is what I meant. Fixed rate has gone up slightly from September, 81%. And then interest cover came down slightly from 3.9, 3.7, a reflection of the higher interest cost that we are paying now, right? So average cost of debt creep up by about 0.2 from 2.5 to 2.7. Okay. I don't think I want to run through in too much detail. All I can say is the portfolio remained, occupancy remained pretty stable and it's creeping up as well. The whales, slight movement, nothing to shout about. And this again, the main thesis about diversification. I think the top 20 now contribute less than 20% of our overall contribution income-wise. Yeah. Okay, I won't touch this. This one I mentioned before. And yeah, I think overall we still seen a nice improvement in overall retail occupancy. Raffles City, I think because we have completed the AEI, we took the entire space back into the market, and hence we're about 91%. Not all the space in the AEI has been fully let. You know, it's about 70%. I think later on, I'm not sure whether you'll be participating in the walk at Raffles City post lunch, right? Post lunch, yeah. So we can have a look at what we have done over there. Yeah. Overall reversion, I mentioned earlier, I think we have achieved positive reversion even for downtown mall, you know, and that's a positive development. And in the fourth quarter, it's gone positive for both downtown and in either incoming or average, right? Yeah. I won't talk about this too much. I think this one I mentioned before. Downtown continue to lead the uplift in terms of the sales improvement. Yeah, and we surpassed 2019 sales now overall, both downtown and suburban. Right? Yeah. I won't say about this too much. Office-wise, occupancy has improved, 94.4. So in Singapore context, 96.2. Average rent about the same as what we reported in September. Reversion remain healthy, 7.6% compared to third quarter is about 7.9%. Retention rate remain very healthy, 81%. Yeah. And this is just a breakdown. Okay, we've seen some creep up in occupancy at the Australia side as well. We hope to build on that momentum, and as the return to office hopefully will pick up throughout the course of this year. Okay, I won't break this. All right. So all these are a little bit more things for you to digest at your free time. I won't delve too much. Okay. In terms of outlook, naturally, I think there's a little bit of a dark cloud out there. Everyone knows about it. There's no surprise. There's been news about various job attrition, you know, tech company particularly. Some impacted Singapore. We have not seen a very widespread impact in Singapore yet, but naturally, because the environment is in the mood of rationalization, we tend to see quite in line with what some of the consultants are saying. I think going to 2023, we'll see probably a little bit of slowdown in terms of rental growth. But nevertheless, there are other positive factors underpinning Singapore's office market. Demand beyond the trade sector, I think it's been, I would say, quite decent. FMCG, we have legal business support services are still expanding. The legal fraternity, I think, are also looking at expansion. Some interesting things like which Singapore is anchored strongly in this part of the world, as being a champion on ESG and sustainability. And we've seen a lot of companies starting to move into Singapore as a base. So we have seen some nice traction. Hopefully that will transmit into some real demand for space. Yeah. I think retail-wise, trajectory-wise, hopefully first quarter, riding into the festive period, we'll see nice improvement. And as the flight gate I mentioned, China, I don't know how many will fly into Singapore. Certainly there will be more tourists coming in, and hopefully downtown more will continue to get that push momentum. Suburban mall, as I say before, will remain pretty resilient. Yeah. So overall, a little bit of dark cloud, some things to match on. What we have been actively doing in 2021, cost management is important. Interest rate cost management is very important. We'll continue to do that. Yeah. This is what I mentioned. So we are looking also to hopefully complete our AI Clarke Quay this year. We are already planning ahead. What next? There are a couple of projects we are studying, and at a timely moment, we'll just let you guys know, right? Okay, I think I'll stop here, and our colleagues can join me. Yeah, very fast.
Sorry, I'd like to invite the rest of the management team up on the stage for the Q&A. Before we start, I'd like to introduce the management team. To Tony's right, we have Ms. Wong Mei Lian, our Chief Financial Officer. To Tony's left, we have Ms. Jacqueline Lee, Head of Investment. And to her left, we have Mr. Lee Yi-Chuan, Head of Portfolio Management. Some housekeeping rules before we start. For the physical audience, if you have any questions, please raise your hand. When the mic comes to you, please stand up, say your name, where you're from before you ask your question. We'll be limiting 2 questions per person per round. If you have more questions, we'll come back to you. For those online, slow down
your question. Sometimes I need to remember.
Yeah, for those online, if you have any questions, please drop them in the chat box. Okay, if you are ready, we'll like to invite the first question from the floor, please.
Mervyn, yeah.
Mervyn.
Hi, Tony and team. Congrats on the good set of results, and Happy New Year.
Thank you.
Maybe the first question from me is retail rental reversions. I think 1.2% average for a full year. Any sense on what was the number in the fourth quarter and the outlook from here? And are you having difficulty pushing through the high electricity costs, service charges? Second question I have is regards to the distributable income adjustments. There's a negative 36 million of rollover adjustments, I think, related to some tax issues. Maybe you can explain exactly what's happening there. Thanks.
Okay, good. Wow, very sharp. Okay. The fourth quarter overall, we achieved close to 4% reversion. That's combining the suburban and downtown. Thereabout, yeah. Whether it's enough or not, like I think I was talking to you down there, I think this year going forward, not just the expense line, I think of course we try to manage the revenue line as well. But we're also very cognizant of the fact that the inflation is hitting the retailer quite badly. Some of them have moved up the CPI. I mean, basically the retail sales price, I'm sure you guys feel the heat, right? But not all of them are able to fully absorb the cost. So we'll be very cognizant. But if more importantly is to be able to drive their sales. So we still think that the sales component of the rent would be very, very important. And that's where I think we'll put a lot of effort into it. Yeah. So we'll be a little bit more I would say, accommodating from a fixed rent perspective, but we'll try to drive the turnover rent. And we had the year pretty decent. I think overall, I think GTO runs about 7+%, which is not slightly on the high side. Yeah. Second question, abatement, I have passed to maybe. Is it abatement? Talking about the distribution adjustment.
Yeah, I think this disclosure was made earlier in the first half results. It's non-cash in nature. So this relates to the COVID-19 cash grants that was received in 2019. Yeah. And it was actually distributed as a tax-exempt income. And subsequently, we had the IRAS came back to us to sort of confirm the position that it should not be a tax-exempt income. It should be under the taxable income. So there was a rollover adjustment to adjust for the over-distribution of taxable income in 2019. Non-cash in nature, has no impact on DPU. No.
It's a bit like reclassification, right?
Yeah, it's a reclassification.
Yeah.
Can we have, David from Daiwa?
Good morning. Tony, you mentioned that last year you were very proactive and prudent in the management of your balance sheet. But as a consequence, did it limit your ability to make opportunistic acquisitions? Because you gave a few major deals a miss in the second half of last year. So can you just remind us, what is your stance on potential opportunistic acquisitions last year? And then looking ahead to this year, the fact that your gearing is still 40%, will that still limit the size of investments you can make?
Yeah, sure, thanks. So I think of course, we look at holistically, right? Portfolio reconstitution, what we want to do, overall portfolio. We look at market condition, we look at opportunity out there. So it's a triangulation of all things we factor in any kind of deal assessment, right? So it's no different in 2022, 2023. So we'll continue to be able to see whether we can fine-tune our portfolio construct. Market condition is allowable. Obviously, we would like to participate and hopefully can have some kind of accretive acquisition. So it's triangulation of everything. So I don't think 2023 will be any different from the way we look at it in 2022. Yeah, 2022 has been very, very volatile, especially in the third, fourth quarter. You probably know the market condition is not exactly there. Yeah, hopefully 2023 market condition is a little bit more favorable.
Brandon here from CICT. Just one question. I think your past 2 quarters, you have mentioned that some feasibility studies are in the midst of some of these redevelopment opportunities. Can you share anything on that, on the progress? What kind of things are you looking at? Properties, or is it AEI? Is it going to be a big, major redevelopment?
Yeah. So cut across different scale. AEI ongoing. We just have to prioritize timing wise. Redevelopment, certainly we have put a little bit more effort into studying that. Both downtown and suburban, both retail and office offsets are under study. At this moment, we can't say more because there are different aspects of the redevelopment that we need to consider. Cost is one, obviously. The other factor is, of course, the scheme, whether the scheme makes sense in that location, and ultimately there's a lot more time that will be required to negotiate, right? There's a negotiation time that you require to go through with the authorities. So it will take some time. I think I mentioned before, even if I think last year I mentioned a couple of times that even if we say this is what we want to do, it won't transpire in 2 or 3 years. It takes some time for things to work through. Yeah, especially it's a live mall, right? You don't just kill a live mall on day one. You need to plan ahead. Yeah.
Okay.
But it's certainly something we are working on it. Yeah.
Okay, thanks. And just going back to the DAI part, right? I don't see a lot of outstanding AEI actually. So is there a chance that, I mean, any reason why you didn't give back, some of the distributions from CLCT as well as Central?
Oh, the two REIT holding.
Yeah, I mean,
Uh,
I know traditionally you have
Yeah.
always withheld those,
yeah,
but
yeah. I think it's always been very helpful. We have the cash flow stream coming from these two REITs to help supplement the capex cost requirement. So I think we still maintain that stand. I don't think we need to dip into that. We have enough. I think we have sufficient things we can work on. Yeah.
Next, can we go to Tan Shen?
Hi, morning. My first question is on Galileo. Can you give us some update on that?
So during that quarter, I'm not sure I met up, but certainly some people have met up. I think we are still working on potential scheme, not ready to mention anything yet. So this year we still have income. By Jan 2024, officially the lease will expire. Between now and then, we are looking at different potential kind of configuration if we were to do an AEI or a major uplift. So I think we're still working through the detail. Concurrently, I think there are prospects we are speaking to, and hopefully that will transpire into something more concrete. Yeah. At the moment, nothing more to say there. Yeah.
Thank you. And my second question is on acquisitions. I think earlier you mentioned diversification. Does that mean you're looking more at overseas acquisition? And also, what are your thoughts on sponsor assets like ION?
I need to clarify. The one of the major reason why we look at overseas diversification is precisely we think we have growth in Singapore that we need to ride on. Earlier, as Brenda asked the questions, right? AEI and redevelopment, all this will have a drag on income. And if you're going to just depend on the one source of opportunity, I think you're just limiting your options. So for us, in the long run, I think it's good to have the optionality in place in the market that hopefully over time we can scale up so that you'll get the economy of scales impact. At the moment, the two market we are in there, we're not there yet. Yeah. So Singapore has opportunity. We have obviously explored some different deals flow, but we didn't proceed. We'll continue to do that in 2023. Yeah.
Yeah, next, can we have Gula before we turn to the questions online?
Hi, thanks. Thanks. Congratulations, Tony, for the results. Can I just, well, I can only ask two questions, right? Okay, so the first one is, will you be writing down Galileo any further? That's the first question. And the second one is, Raffles City Convention and Hotels comprise of around 6% of the AUM. Can you remind us what the lease structure is like? Is there any upside from the revenue if the hotels fill up, etc.?
Yeah, okay.
Convention.
So we certainly hope this time write down would have absorbed most of the impact that Germany is facing. The inflation is one big one. Of course, the war is a risk premium that's gone up, right? So overall, hopefully that reflects the risk has been priced into the valuation. Ultimately, it all depends on how we execute the plan. Today, the valuation take into consideration the cash flow expected from potential capex that may be required, the downtime as a result, no income stream, and hence on the discount basis, an elevated discount rate pricing in the risk premium. So that all contribute into from a DCF perspective, a low valuation. Hopefully that has been fully captured. Yeah. Whether there'll be further write down, I can't tell. It all depends on how we execute the asset planning. Yeah. And of course, the war in Ukraine is still ongoing. Yes. Yeah. Even though recent months you begin to see less pessimism, less pessimistic numbers coming out from the Eurozone, and especially Germany. Has been seeing a little bit of a surprise upside in economic activities. So maybe people got used to it. Maybe they got over the the deep winter where the fear on the energy rationing will have a major drag on their economy. That has not panned out as bad as they anticipated. Yeah.
Yeah, I think Gola has the next question on the RC hotel lease structure.
So RC structure, well, if you recall, in 2020 when in the darkest moment, we had a little bit of readjustment on the lease structure with the hotel. We essentially, in short, we really bring down, like no different from what we have done for some of the retail, the most affected retail tenants, bring down the fixed costs, fixed rent, and then bump up the turnover. And we adjusted the duration of the lease because the hotel said there's a need for them to have a longer lease period to make up for the time. So that's been factored in. In the course of the last 2 years, things sort of revert back. The fixed rate gone down a little bit, variable rate came down. Overall, on the net basis, I think we have probably done the right thing because we have seen quite a nice uplift in the sales, the room rate, and then the F&B has been doing very, very well in the hotel. So in fact, 2023, RCS is one of the big booster in our performance. Yeah. So I think we are quite pleased with the outcome. Yeah.
I'll come back to you, Yu Kiang and Derek, Rachel. Turning to the questions online, we have a few on tenant sales from Terence, UBS, and Joel, DBS. So their question is, for Q 2022 tenant sales, how does it compare to 2019 levels in terms of overall downtown and suburban? And also, how much of this came in November and December? Is it due to GST front loading? Do we compute tenant sales net of tax and expectation on tenant sales in this year?
Okay, a lot. Luckily, I did my homework. So fourth Q on its own versus 2019.
Yeah, that's right.
2019 your number, I don't know, but versus overall for the fourth quarter, that means the whole 2022 and 2019, downtown improvement by about 4.4%, and then suburban is about 7.5%. Overall, it's portfolio about 7.2%. Yeah, I don't have the fourth Q number. Maybe our teams will check later. Yeah. And then the on the what?
Tenant sales guidance for this year.
I hope I also hope that we had that crystal ball gazing. Earlier I alluded there's some positive momentum, positive attributes that we can carry through in 2023. Overall, looks like inflation number has been tapering down, so hopefully that will transpire into a less than expected adverse impact on consumer sentiment, right? Because ultimately it's inflation that they are concerned about. Hopefully, economy will ride through well. You know, MTI has marked down the economic growth this year. There's been some headline job attrition, but overall the unemployment number is pretty low in Singapore, still very tight. Wage certainly is going up. Whether it's enough to cover inflation to the extent where it affect the consumption, anyone's guess. First quarter, we think we have a little bit more visibility. Hopefully, January to February, things will be okay. People are still in the bonus period, right? So there'll be a bit of discretionary spending, and of course, the usual necessity spending will be still there. Anecdotally, I do go around the property, a lot, and we speak to tenants. While we see some media report that, in fact, even today, some media report that the chicken people are selling less, in the wet market. But I've been asked around some of the retailer, and surprisingly, they are saying that this year Chinese New Year sales peaked faster than last year, and overall the number has been very robust, stronger than 2019. But we'll see the number how that transpire. Yeah. But from an F&B perspective, I'm sure you guys on the ground, right? It's always full. Even leading up to Chinese New Year, of course now it's pretty full, but leading up to Chinese New Year has been very, very, very packed. Yeah.
We have a next question from Sutai from Mercury. DPU lags behind revenue and MPI growth. Was this due to interest costs being higher than expected? Can you guide us on the borrowing cost trend in this year?
She wanted it?
I think borrowing cost is definitely one factor that is below MPI line, so that would be affecting DPU growth. The other element is that in late 2021, we also did a small placement, so there is an enlarged number of units. So that also is one of the factor as well. So these are the two key factors.
Okay.
Borrowing cost trend, I think we all know that we are in a rising interest rate environment. And going into 2023, I think there's all eyes on the Fed. There seems to be some signs of cooling. But having said that, I think rates have stayed quite high. So we will be watching carefully over the next few months for the indication of where interest rates will be, and we'll react accordingly for the debt maturities that we have in the next 6 months on timing of hedging these fixed rates.
I can also add to what Mei-Lian say. If you look at 2022, we did some work, right, in terms of portfolio movement, right? So earlier I mentioned we sold JCube in March. We did some placement in December 2021 in anticipation of the 3 Australia asset, which was completed only in April and June. So there's a little bit of timing difference. So we have naturally a couple of months of DPU impact drag. Then we sold Sky. We acquire, we sold JCube and we acquired Sky. So again, it's a bit of timing difference. So that's one element. The other element, if you do recall that when we acquired the Australia asset, we also had a bit of guarantee income which we have not touched. So we keep it as a option that we can look at it in the future. Then the other element would be some of the AEI downtime that was not on a pro forma basis. You don't build that in. So downtime from AEI as well. Yeah. So going to 2023, you'll see hopefully the downside effect from Raffles City, 2023 will be lesser. We have some remaining space in the AI space to lease out. And Clarke Quay will go through a little bit of period of a quiet period, especially for South. Second half, hopefully you'll catch up. Some of the rent amortization effect will slowly taper off in 2023. Some of the bigger lease that we signed in 2021, 2022, forward commitment, when lease commence, you recognize that the revenue, but there's the underlying cash flow has to amortize over the period of time. So that will taper down in 2023, and you'll see more cash impact coming in. So I'll just give you a little bit of hint where the potential trigger of the number will come.
Okay, coming back to the physical audience, maybe we can go to Derek first.
Hi, Tony and team. Just wanted to follow up on the interest rate question. For fourth quarter, what was the all-in interest rate? And some of your peers have mentioned they expect to see about 40, 50 bips increase in the all-in across this year. Would that be, a fair statement to say as you, refinance into higher rates?
The fourth Q interest rate is at about 3%. Yeah. So going into the new year, we are looking at a higher average cost. 40 to 50 BP may be possible, depending on where interest rates levels will be. Yeah.
All depends on your hedging strategy, right? If you take a neutral position, 50-50, you say, I'm not very sure how that will go. It can be a 50-50. Of course, then your average hedge rate will come down, right? But we can live with it. Assuming we unhedge everything, but the refinance as required in 2023, our hedge ratio will come down to close to 70%, which is okay, right? That's the extreme. But of course, you hedge 100%, then we remain at 81%. So it all depends on your hedge ratio. But on the neutral level, I think our average is about close to high threes. Yeah.
Your expectation is for high threes?
I think so, based on today what we see. Yeah. But of course, things will change in the months ahead. Yeah.
Sure. Then just wondering on acquisition opportunities, given the kind of valuation declines for Galileo, do you similarly see opportunities to buy at fairly distressed levels, and which markets do you see that happening in?
Jack, you want to take that?
I think, yeah, we have seen yields moving up in some of the markets, but I think we are still watching because they haven't moved up as much as the interest rate increases. But we are watching to see when that will stabilize. But we are beginning to see some yields move up in some markets.
Which ones?
Say Europe, Australia, yeah, for example.
Yeah. Just a caveat now, when we acquired the 3 Australian assets, we actually went at an implied yield about 5%. So we have sort of, based on the negotiated income guarantee that we get, implied yield is about 5.1%. 5.1, right? Yeah. 5.1%, yeah. So we've seen the market now potentially creeping up now, the office space, the yield, yeah.
Next, can we go to Yew Kiang?
Hi, Tony. Can we talk about Australia? Like, what's the long-term plan? Can we expect you to do retail in Australia over the long term? And then secondly is on the next acquisition. I mean, do you think that the pricing is fair? Can you give maybe some views on that? Is it a structure that you don't like? Would you prefer to have full control of asset when it comes to acquisition, especially if it's a non-related party?
Okay, 3 questions, right? So Australia retail, I don't think we'll rule it out, right? We don't think we'll rule out. If you look at some, at the end, it's about diversification. It's still about diversification, right? We so far we have office assets and some small retail in one of the JV. So that's not full retail. It to me is a small retail, not so management intensive, even though it's a CBD retail, a bit more challenging than what you look at suburban retail. But overall, management intensity, attention span on retail is a lot higher. That's a given, right? So question is whether we have the capacity to take it. So eventually, I think we need to have in-country level also a bit more diversification eventually. Currently, it's mostly office, yeah. And not every market, I think, okay, so you talk about Australia. The Australia retail market and the retail related real estate has gone through the adjustment a lot earlier than what you're seeing now as a result of interest rate impact affecting the expectation of the cap rate, right? But retail has been, since I can recall, it's 20 or 18 or 17, it's been going through the adjustment because e-commerce, people are worried about Amazon going in. So there's already a lot of repricing, and historically retail asset very chunky, owned by a lot of superannuation. They also want to lighten the load, right? So there's been a bit of portfolio reconstitution among the major owner. That's why you see the adjustment multi-years. So it has come to a point where I think the adjustments has come lesser now. And then the new trend as a result of COVID, working from home, is not just prevalent, it's prevalent in many markets, right? And suburban retail has been pretty resilient. We've seen some of the peers reporting the results. Not bad. I mean, the retail doing quite okay. So there'll be, it's a reflection of the cycle, real estate cycle that will come and go. But eventually, our take is that in some those countries outside of Singapore, first we must have the scale. Second, we must have the resource to be able to manage. And retail asset is highly, highly management intensive. So we must have that knowledge there. At the moment, we are not there yet. Yeah. Next move. Oh. You want to see anything about where you see where I think there are some reported transactions out there, which in Australia as well, not just in Singapore. So there are some reported transactions out there. I, like earlier mentioned, we look at it holistically, right? It's as a REIT manager, you manage your portfolio, design what the REIT represent, you manage the source of capital, and then you look at how you want to redeploy your capital. So again, it's back to triangulation. And of course, when the market is conducive enough, then we'll raise a little bit equity from there. It's simple as that. Yeah.
Thank you, Tony. Next, can we have Rachel?
Hi. Hello. Hello, hello. Hello, hi, Tony. Happy Chinese New Year to the team. Just a few questions from me. I think firstly is on office, Singapore office. Do you feel that there's a shadow space creeping up in your portfolio and also in your market? Yeah. And secondly, my question is on how do you see, looking at your portfolio, I think everything seems quite stable. So what's your thoughts? Where do you feel you would prefer to add, like retail, downtown or suburban, or is it office? And divestments, are there still opportunities for you to divest? Is it retail or office in your portfolio? Thanks.
Shadow says, which one you want to talk about? From my colleague.
Hi. Happy New Year to you too. So for shadow space, I think generally in the market, we will think a little bit of creeping up in the coming quarters. I think it's quite known that the tech space, right, we will see some of these things coming up. I think roughly now some of the statistics is around 600,000+, and so slightly will go up. But notwithstanding that, I think CBD office supply generally is still quite tight. So even with this, I think it's not something out of expected. I don't think it's a big challenge or problem at this point in time. Yeah. Thank you.
Thank you. Your question regarding whether downtown or suburban retail is an ongoing iteration that we're looking at through. At the moment, we are quite balanced, 50-50. Somehow, I don't think it's by design, but it's just panned out that way. We're about 50% downtown, 50% suburban. A few trends we watch out carefully. Of course, the work from home will have some impact on how the consumer travel and behave, right? The reopening of border certainly will have a little bit of dynamics. The increased connectivity between Singapore and neighboring country is something you want to watch carefully as well. So there are implications, right? And it will implication on more the out movement of locals rather than the other way around. So I think we are watching all these different dynamics quite carefully. Yeah. So I can only say that at the moment we are in a nice sweet spot, quite balanced. Whether we should swing heavier to downtown or suburban, there are a few configurations that we'll think through. And also it depends on the opportunity out there. And earlier, Brandon asked about where the AI potential or redevelopment potential. I mentioned it could be downtown and office, downtown and suburban, can be office and also can be retail that we are studying now.
Okay, next, can we have Xavier?
Good morning, Tony and team. Thanks for the presentation. Can you help us understand for your integrated developments, those with office and retail component, how reliant are they on the office crowd for shopper traffic versus the tourist traffic? That's my first question. The second question is on your office leasing activity. I think fourth quarter seems to be your lowest number of new leases, about number of committed leases, about 120,000 square feet. Is this a seasonal thing, or do you think this is a sign that the market has been cooling off in terms of the leasing demand for office?
So your question on the impact downtown integrated, I would say at the moment it's still more return to office impact, less so from the inbound travel. It's not very, of course, it has gone up, right? But not very significant in my view yet. And you can read all the statistics coming out from the Tourism Promotion Board, right? The number has crept out, I think, but we're still a long way from pre-COVID. So my view that's why I mentioned the dynamics on the border restriction lifting, and many countries are lifting all the COVID measures. We should see a more healthy two-way flow and hopefully a more inbound catching up with the pre-COVID level. Office leasing, maybe I will pass on to each one. Yeah. Okay.
So for the
Sorry,
office
I got
leasing,
long.
right, I think if you look at the fourth quarter, there's a couple of reasons why the number kind of a bit lower than usual, right, for our portfolio. Because on one hand, it's year-end also. Of course, the market cooling down, maybe a little bit of concerns, but at the end of the year, it's also a time that, festive season deals tend to be a bit slower. But notwithstanding that, I think we do still actually see demand from financial services and legal, real estate also for some of these things. But actually, for our portfolio, there isn't any tech news for the fourth quarter. So actually, we do expect some of these demand to come back a little bit more in the first quarter. Yeah. If I look ahead, I think we are also in talks with some of the renewals that actively, I think things are shaping up quite okay.
Got it. Thanks. Just to clarify, so is it fair for me to think that, with all this hybrid work arrangement right now, for your integrated developments, say Plaza Sing, it may not recover, the shopper traffic may not recover back to where it was, even with the tourist recovery?
Today, we are about 75 overall, pre-COVID, about 75 to around 75 to 80% levels from pre-COVID, traffic-wise. Yeah, potentially, but the buying habit has changed. A bit more intentional. You go to the shopping mall and more intentional. That habit was cultivated during the COVID with all the restriction, right? Whether they be cut off and more leisure, I mean, those, I think it will come back. Whether it's 2023 or 2024, I think we'll go back to pre-COVID. Yes, my firm belief it will be. Yeah.
Thank you.
Okay, I'd like to turn to some questions online. We have a couple on leverage. Are we looking to divest some assets to pay down, and what is the target leverage?
That's part of the portfolio reconstitution I talked about. Maybe I talk without. Can you hear? So that's part of portfolio reconstitution talk about when you look at investment, sometimes you look at divestment currently because it's about how best to look at the portfolio, whether it makes sense to monetize some assets or partial market monetization, and whether the market conditions is favorable at that point in time. So we look at all this in triangulation, and of course we also assess whether this asset is one of the candidate, maybe not this year, but 5 or 10 years down the road for any kind of major uplift, right? So those are factors that would be important before we look at whether we should swap, the asset out into something different. Yeah. So if market is okay, we can afford to hold the asset and ride through, catch and continue to essentially, I don't have to use the word cream now, but optimize further, make sure you work the asset hard further. Market conditions okay, there's no real need for us to swap it out, then I think we don't have to do it. Right? So it's many factors that have to be considered. Yeah.
Thank you, Tony. Yeah. We have a next question.
Of course, there will be an ideal position. We hope at some point in time we will be able to. Today we are okay. I always use the same analogy. We are managing the different stakeholders' interest: equity stakeholder, the debt market stakeholder, the rating agency looking at us, and of course the consumer, right? So we just want to find a position that make sure that we do not underwork your balance sheet. And of course, it's a factor of where your cost of capital in the different pockets of money is at the right moment, whether we should lighten the balance sheet. So there could be different factors that may result for us instantly to look at a readjustment on the balance sheet. But in the long run, I think ideally, a 35-40% kind of balance sheet would be pretty safe, which is what a lot of investors want: a safe, predictable, low vols income stream with no stress on the balance sheet, and give you that firepower in the event opportunity came along where you have to react fast, right? You are at a 40 level, of course, you have less flexibility. You are 38, 35, 9 level, you probably have a lot more flexibility. But it's all again about whether you are able to hold the 35 to 38% and continue to deliver the return you want, that investor expect. Because technically, you may be under working a balance sheet. You look at a private equity, says quite easy to go 50, 60%. Yeah, they are working the balance sheet very hard. But in the public market, we have to weigh the different interest stakeholders.
I have a question on Capital Spring. Did Capital Spring contribute any distributions for you last year? And in a steady state normalized situation, like what type of annual distributions should you receive from Capital Spring?
2022, no.
2022, Capital Spring won't really contribute to 2022 DPU because there are a lot of rent-free and incentive given, yeah, in 2022. Yeah. For 2023, we do expect some distribution to come back, yeah. On the question on steady state, I think we have to come back to you. Yeah.
Essentially, you're asking the amortization effect as one. Now, of course, at the local entity level, the level where you're able to upstream the remaining cash out after settling all the different costs and expense, right? That's another matter. Yeah.
Okay, jumping back to the online question. Sorry, Mervyn, we'll come back to you. We have Raven from Martin Curry asking on the profile of new tenants who have been taking up space in the past 2 years, and what's the guidance on the rental reversions going forward for retail and office?
Each one, you'll take that.
The first question is on the profile.
Profile new tenant coming in office.
Okay. Well, I think just to kind of okay. So for the fourth quarter, just to recap, right? Most of the deals, the new demand that came to our office is actually the financial services and legal making up most of it. And of course, I don't think it's really that, it's just a function that in the fourth quarter we didn't see any tech deals, but I don't think it's anything very specific at this point to point to anything. We also see some real estate companies coming through. I think the co-working space, we're also seeing some inquiries and demand. And of course, it depends on the kind of models that we are going to actually see going forward. Yeah, that's for the fourth quarter. And the next question.
And guidance on reversion.
Okay.
Retail and office.
Okay, so for the reversion, I would say the first quarter going forward, we should still see pretty good reversions. And similarly for office, I think if you look at the rental growth, right, I think the market rents generally it's higher than the expiring rents we are seeing for for 2023. Hopefully this works out well for us. But I think the rental growth is probably going to slow down a little bit for this year, especially second half of it is going to be a bit more uncertain. But I think it should still be holding up okay. Yeah. Thank you.
Okay, Mervyn, circling back to you.
Yeah, I got a question in terms of the borrowing costs, questions from investors who's emailed me. I think, Milian, you were saying that borrowing costs could go up 40, 50 bips. Then Tony, you mentioned high threes. Is the high threes related to when you refi or the weighted average for the full year FY23? Refi. So it should be in line mid threes with as per the other REITs that we're seeing, or if you're lucky, K-REIT around 3%. Yeah, okay. Maybe you can touch on the occupancies for a couple of buildings, Capital Tower and 6 Battery Road. Do we expect improvement in occupancies this year? What are you seeing in terms of negotiations? And then turning to Australia, what's the plan there? Are you aggressive with offering tenant incentives given the income top-up that you have? Thanks.
Okay, so for the occupancy for Capital Tower and 6 Battery Road, right? Maybe I think for Capital Tower, I'll start first, right? I think generally we previously had JPM space and we have actually backfilled a big part of it. There's interest in some of the balance space, so definitely I think for Keppel Tower, we can expect some of the occupancy to go up. I think Salisbury Road, similarly, we'll be finishing some of the upgraded floors, and then we'll start to actually fill up some of these spaces. So I think it should also be going up. As for Australia, okay, so for Australia, the occupancy, right now we do see actually the return to office is a little bit slower compared to Singapore. So the plan there, for some of our assets, we are also trying to put in certain differentiating factors, and we are starting some of the plans to find how we can actually best, position the asset to capture the return of office and the interest when it recovers.
Some of the trend we see in Singapore is also beginning to shape up in Australia. Like the prevalence of certain hybrid model, co-working space model seems to be shaping up. So one of the property that we are working together with our JV partner is really looking at the utilization of the co-working space. So I think that as a result, we are upgrading some of the aspect of the office. The lobby, I think, is going through a major revamp. So we are bringing up the level higher. The other one that Yichuan alluded to was, I think, it's more 66 Govan Street, which is in the CBD, not North Sydney. And there has been some departure, which allow us to fast track some of the planned capex when we look at our underwriting. We actually had some capex that we set provision to cater for the upgrade, because the building is a little bit like Capital Tower. I mean, it's grade A, but it's not premium grade, right? But we think that there are certain aspects of the building can be further improved, but they have a life tenancy there, which you can't do anything. So when the lease expire and tenant decided to move on, we decided to take back the space and do a major upgrade. Yeah. So we are quite reasonably positive on 66G that you will creep up again. Yeah.
Just final question from me. How should we think about the remaining stake in Capital Spring? Is it just the cap rate is too low at this point?
Well, it's in our radar. We think about it as well. Of course, in the midst of different opportunity, we will see which makes sense. Yeah.
Sorry. Yeah, just to add on a point, I think I missed out earlier. When we talk about incentives, right? I think for the Australia market, the incentives generally have crept up in the past year or so, but I think it's currently around 30 to 40% range. I think it's quite normal. Do we expect this to go up? It's really hard to say because it's really on the deal by deal basis. Yeah.
Yeah, Rachel.
Hi. Yeah, just one quick follow-up question. For Clarke Quay, I saw you sign on 2 tenants. Just wondering what's the pre-commitment level and what's the interest like for the remaining space? Thanks.
At the moment, including those, we are in deep negotiation, around 80%. Around 80%, yeah.
Sounds good. Yeah. All right, thanks.
We have 2 online questions on valuation. On the drop of valuation for the Germany asset, how much is it due to the weakening of the euro versus Sing dollar? And how much is due to the assets in euro terms?
I think in terms of the FX translation effect, we have about 170 million of the loss due to FX devaluation of euro and Aussie dollar against Sing dollars. But this is largely mitigated by the corresponding fair value gain on the euro and Aussie dollar borrowings that we've taken to fund these overseas assets. So the impact on net asset overall is actually mitigated to a large extent.
Maybe each one you talk about the euro valuation, which I earlier in the presentation touched a little bit. Maybe each one you want to give a little bit more color on valuation on our German assets.
Okay. Yeah. So I think for Germany, we this time round, right, actually, because a lot of we actually the valuation dropped partly also because we took in some of the latest assumptions that what we are going to foresee in this property. So, for example, there's a bit of higher capex actually taken in. It also reflects the kind of downtime that we're really expecting. So, as far as possible, we think that this valuation hopefully already kind of takes the hit that we will see in Germany. But of course, eventually, it's hard to predict, next year how the valuation will hold because a lot of variables are moving. But by and large, if let's say once we have a bit more certainty on the plans, hopefully some of these things will reflect in the valuation at the point in time.
So it's a bit, if you look at purely from a reval gain or loss on the portfolio, it's a mixed bag because you have the corresponding balance sheet effect, right? Liability asset netting off a little bit, and as a result of your natural hedging on your borrowing side, so that can mitigate. Absolute valuation number for individual property, I think range in Germany it's probably about 15% for Galileo, 15, right? I think a 15% markdown, and then the MAC single digit. I can't remember the number, but single digit markdown. Yeah.
Another question on valuation from Andy, Bank of Singapore. Why did Bugis Plus registered a slight cap rate compression while a couple others had a mild expansion?
Which one you want to do? Bugis Plus.
Cap rate
slight
compression.
That one, for Bugis Plus, some of the valuation cap rate changes are actually more function of a change of valuers. Yeah. So you will see probably a few of them actually have a very marginal expansion, and the Bugis Plus has a slight compression.
I would suggest do not read too much into the cap rate. We had a change of valuer. It's through rotation, right? Every 2 years we do rotation. So some value will have their different views, how they look at asset. They have different growth assumption, right? And then they will look at the risk premium adjustment in the discount. So by and large, different value will have different view in the specific asset in the specific locality. But on a net basis, I think the adjustment or the cap rate was like 5 to 10 pips is very marginal. So don't read too much into it. Yeah. More important, look at the trading, basically operating yield of the individual asset. Currently is all above the current cap rate that's represented.
Next online question we have from Gerard. What is the physical occupancy for the offices in Singapore, Germany, and Sydney? And what is the current trend?
For Singapore, right, we actually see a range across our properties, right? Some are actually as high as 90+%. It's almost like back to pre-COVID levels. But of course, some is trending a little bit lower. I think broadly we are 70+%. For Germany and Australia, the physical occupancy return to office rate is actually much lower. I would say that in Australia, if I were to put a number to it, it's probably around in the 50-60+% range. And in Europe, it's probably going to be a little bit lower. I think it's also the sentiments generally and how the return to office has. I think in Singapore, there's a little bit more push for people coming back to office. And actually, in this aspect, probably this year we might even see more companies taking a clearer stance on their return to office, and hopefully this will then translate to higher return to office rates. Thank you.
Just give you a sense, in terms of rate varies, different property to different building to different building. It all depends on the companies, their policy, right? But generally, Monday, Friday is lesser. You can say Monday is Friday lesser. Tuesday, Wednesday, Thursday, generally quite high, in the 80s and 90%. Some building above 90% return rate, which is very, very healthy. By then you can taper down to 60%, 50% on Monday and Friday. On a portfolio-wide basis, on an average on a week, you're looking at maybe 60+, mid-60s kind of return rate, which is decent. We don't really track so intensely the pre-COVID. So I'm not sure. I agree with your sense that some of the building is already back to pre-COVID days. 80-90% certainly sounds very high, given that some of the people will be either traveling, or maybe they could be working from, looking at, maybe they're meeting clients out there. But it sounds pretty much to me back to normal on a busy day, right? But that's only on the 3 days I mentioned. The Monday and Friday tend to be a little bit lower. Yeah.
We have an online question from Andy, Bank of Singapore. What is the retail occupancy cost? And for Australia properties, how long do we expect for occupancies to ramp up to above 90%?
For the retail occupancy cost, generally it's around the 16+% range. So it's actually quite in line, generally within the acceptable range of what we're looking at. Yeah. As for the occupancy in Australia, right, I think to get it above the 90% range, probably it will take a little bit of time, given that's how things are translating. I think a lot of things are actually relying on how things pan out in the North Sydney side of things. But I think, yeah, it will come back. I think we're not that far off. It's just something needs a little bit more time to work on.
Yeah. Just to add what Yi Chuan is saying, currently it's in the 80s, 80 plus, mid 80s and above. That's the retail retail space in Australia. And what Yi Chuan you're alluding, the coming back to the office is a bit low in Australia. Ballpark, we don't track the number, but anecdotally from our ground guys on the ground, they say it's probably about 50%, 60% back. Yeah. At the same time, we are together working with our JV partner Mervec, right, looking at the retail space, and we need a rethink now. So we started with good thing is the integrated project. Next, it's connected to the main subway line, the metro line. So it's on a busy day can be very busy. But the kind of retail space configuration, I think, needs to a little bit of rethink. And at the same time, because of the connection to the office building, and we started embarking on the upgrading of the office building, including the entire lobby area. So it makes a lot of sense for us to extend to the retail space, which is connected. Yeah. So that will be a work in progress. Yeah. It may involve a little bit of AI potentially. Yeah.
I see Donald has a question.
Yes, Donald for Bank of America. Two quick questions from me. First is, can we have an update on Twitter? Are they still paying rent? Will they be paying rent? And if we need to backfill the space, are we expecting positive reversions on that or flat? Thank you.
Okay. So for Twitter, right, are they paying rent? Yes, they are paying rent. Will they pay rent? I hope they continue to pay rent. But I would just say, I mean, just aside, for Twitter, I think right now they're still a tenant of ours. But broadly across the board, I mean, we constantly talk to our tenants about the expansion and right sizing plans along the way. And I wouldn't, so while some of these discussions are happening broadly as a whole, right, I don't think I'll comment too much on Twitter itself, whether there's any reversions now, because I think it's a little bit ahead of time.
What's the exposure to tech now for the portfolio?
As a portfolio, our exposure to tech is actually quite manageable. It's actually below 5%. And actually, if you look at it, right, Twitter is not on one of our top 10 tenants in terms of exposure. So I think the exposure side is actually quite manageable.
Got it. One last question is, could you remind us on the utility costs for this year again, the repricing, and what sort of impact are you expecting, and if there's any mitigation from service charge and all things?
So I think we want to touch it.
Okay. So for utilities, right, we are probably looking at tariff alone is probably somewhere, I think the last time around you mentioned, it's probably about 90% over the current one, right? We have been actually increasing service charge from a few of these properties with effect for 1st January. Generally across, if we look at both retail and office, unfortunately for retail, right, because of COC, we can't immediately, any increase in service charge, actually, it will really only take effect kind of in the next renewal cycles. But broadly, I think in terms of whether the service charge can actually cover the increase in tariff, I think coverage ratio is currently around 35-40% range. And then progressively, this number will go up as, if you look at how the expiry lease profile retail will go, we'll start to, put in back some of these things in the subsequent renewals.
When is the next contract, when is the next contract renewal, the rollover for the utilities?
It already end 31st December. So we have another lock-in 2 years rate.
2 years, okay.
Yeah, 2 years rate, yeah.
Okay.
Earlier I mentioned, I think it's higher, potentially around 50% higher than blended 2022. But 2024 will taper down a little bit. Yeah.
Got it, thanks.
Yeah.
Do we have any one last question? Okay, then I think that we have all the questions addressed. Thank you for your time. We look forward to seeing you again.
Thank you.
Thank you.